with rising interest rates, we're starting to see mortgage companies start their layoffs. Is this going to be a trend that we're going to see in 2022, not just for the mortgage industry, but just the real estate industry as a whole? As always, guys, I'm the Flippin' Landlord Ninja, and we are Two Guys Take on Real Estate. So I just read an article about Wells Fargo starting layoffs. They didn't announce how exactly many they're going to be doing, but they are significantly starting to increase that, as well as Rocket Mortgage and quite a few other smaller mortgage companies. They're basically touting that with rising rates, they're setting less and less refinances, and they're not seeing as many new loan originations. So therefore, they are obviously needing to cut their expenses. Otherwise, they won't be able to survive. So this is kind of generally where it starts. You definitely see that as the kind of precursor to other parts of the industry in real estate to actually start layoffs. So many of you might not think about it, but real estate, other than just housing and mortgages, there's so many other factors and other parts of the industry that are affected. Construction, home improvement. You got your Home Depot, your Lowe's. These people all staff up as more housing demand comes, as people are looking to renovate their houses that they're buying, or if they're looking to buy new furniture. So then you got the furniture stores and all these. It's a big market. That's why generally the government doesn't want to see a housing crash, which I still don't think we're going to see a housing crash. It's more likely going to be kind of a softening, especially with the inflation, and the interest rates are going to have to keep pushing those up probably, and that's what they've said, that they're going to try to combat inflation. But they're still going to want to kind of have that kind of that balance. They're going to kind of walk along the edge, so to speak, because they don't really want to fully crash the housing market. The good news is, because of the Dodd-Frank Act back in 2000, after 2008 crash, there's a lot of things that were put in place so that we can't see as many risky loans that were, the no-doc loans, the ninja loans that we saw back then. So we're not seeing that now. But what I have started seeing is more people are now looking at, instead of getting fixed rate for the investment property specifically, more and more moving towards, and even some actually homeowners I'm hearing are moving into more adjustable rates, which that's kind of scary, because that is what a lot of adjustable rates happened last time in 2008, and that kind of was part of what led into a lot of the riskier loans that were happening. And then, unfortunately, when these things adjusted, people weren't able to afford them. And if rates adjust, so that's where we're also kind of finding ourselves. Do we? We have a 4-family house that we're acquiring right now, and I'm trying to look at, do I look at the interest rate right now? I could lock in maybe a fixed commercial loan at maybe 6%. Which seems high when we were looking at 3% and 3.5% for commercial loans not too long ago. Or do I look at maybe what's called like a 10-20, which is fixed for 10 years, and then it either balloons after that 10 years, you have to pay the whole thing off, or it starts adjusting. And it's generally why it's a 10-20, because it's a 20-year amortization. I have talked to some banks that are willing to do maybe a 10-25, so it's a 25-year amortization. But it's really, do I feel, and as an investor, do I feel I will be safe and secure in a 10-year that the rates might come down enough that I can refinance that property after that or before that 10 years is up, and then hopefully move into something more longer term? Or do I just bite the bullet, maybe at, the 6% versus, within the 10-year, I'm seeing now maybe a 4.5%. But do I just bite the bullet and lock in a long term so I don't have to worry about it? There's, I know what my risk is. I cap my risk by knowing next 30 years I'm fixed at this. I am becoming more and more risk adverse as I get older. So I think I might kind of err on the side of caution on that and kind of focus on really more long-term fixed rate. We did just do a massive $11.5 million fixed 30-year. So that is kind of more where we're shifting but there's only so much you get. So a lot of commercial loans, especially when they're like industrial or, shopping plazas, stuff like that, you're not going to generally find a 30-year fixed. At least I'm not. I've been searching some more. You are looking for as long-term fixed as I can get which right now I'm seeing is mostly 10. So I've been reaching out to credit unions. We've been talking to a lot of local banks, and so what I'm trying to do is maximize cash flow, trying to find the longest amortization schedule I can get with the longest, to minimize my risk, my longest fixed rate. So right now what I've been seeing is a 10.25. So that is probably where we're going to err on for the most of our commercial properties. Like right now I'm at a foreclosure auction. For a shopping plaza. If we get this, we probably basically do some value add, do a BRRRR strategy. So we'll buy it at foreclosure auction at hopefully really cheap. And then we will do some ads, roof, reset new tenancies, convert tenancies into triple net, stuff like that, do all the value adds to increase the value of the property, do a BRRRR. So, basically refinance that into as long-term fixed rate as we can with longest amortization so that we can maximize cash flow and minimize risk. So that's kind of what we're seeing. That's how we are structuring our stuff. So I hope this was helpful. If it is, make sure you give a like, comment. I'd like to know what you guys are doing. What are you're doing for your investment strategy? And if you want to check out other videos, check this one that YouTube's suggesting you might really like. So thanks a lot, guys. Have a great day.